So to do that, we needed a clear vision. And our vision at that time was pretty simple. And by the way, this is still the same vision that we have today, 10 years later, which is build a best-in-class, pure-play company focused on semiconductor solutions for data infrastructure. Now, at that time, data infrastructure was not a recognized market category. It was the term that we used to describe the infrastructure that was going to be required to move the world's data, store the world's data, process the world's data, and secure it. But like I said, we were not in that business yet. And frankly, we didn't even have a lot to work with as we went after it. We had some. So my team and I came to a conclusion, which is that we would need to build these capabilities internally, and others we would need to build through strategic M&A. And we had to get focused. Because when you're transforming, it's not just deciding about what you're going to do, it's equally important to decide what you are not going to do. So with that strategy in place, we got to work. We began systematically building Marvell around that vision. And it wasn't just one move. There was a series of deliberate choices. We looked for the premium assets in the markets that mattered the most, the best companies, best technologies, the best teams with the strongest market positions. Now, we first started by divesting businesses that weren't aligned with our strategy. You can see some of those there. Then very quickly, we acquired Cavium to strengthen our compute and networking capabilities. That was back in 2018. 2019, we divested our Wi-Fi business. Again, we were focusing. But we acquired Avera to establish our custom silicon business, and then Aquantia to bolster our connectivity portfolio. In 2021, we followed all that up by acquiring Inphi for $10 billion. It was our largest acquisition to date, and we got world-class data center connectivity technology into the company through that. And we acquired Innovium the same year, adding high-end data center switching capability to the portfolio. So then we took a break. We took a few years to digest and focused on unifying and building out our whole technology platform to address the data infrastructure opportunity. But over the last 12 months, we fired up the M&A engine again. We divested our automotive Ethernet business, again, power of focus, and acquired Celestial AI for its photonic fabric technology and XConn for scale-up switching. So if you add it all up, over the last decade, we've invested roughly $22.5 billion through acquisitions. We spent $18 billion organically inside of Marvell to develop the platform, and then we divested approximately $4.5 billion worth of assets. So all in, we've invested roughly $36 billion investing in this platform. Now let me show you the result of some of these investments. First of all, we have built an incredible technology platform, and it all starts with the advanced process node. It's one of the most important decisions we made, actually, was to become a process node leader. Now, Marvell, Cavium, and some of the companies we acquired had all been fast followers, meaning you're like a node or two behind on everything you do. And that's largely a result of just not having enough scale. That's usually why people do that. But as we integrated these businesses, we made the decision that if we're going to compete in data infrastructure, we had to be at the absolute leading edge. No choice. Now, here's a little known fact. Marvell skipped 7 nanometer completely. We made a full node jump at that time from 14 and 16 nanometer all the way to 5. I mean, nobody does this. Nobody takes that kind of a risk or a bet, but we did, and it worked. It worked really well, flawlessly, actually. Our engineering team did an outstanding job executing this transformation. So in early 2020, we released our first world-class IP platform, complete with die-to-die interfaces, custom SRAM, high-speed SerDes, and more. Now, SerDes is a good example of how we built this platform. It combined Marvell's own core engineering strength with exceptional talent from Avera, Aquantia, Inphi, and others. Now, today, that is a 1,500-person organization at Marvell, second to none in terms of engineering scale and capability. So to support the process data portion of our mission, we built a best-in-class custom compute platform, working in deep partnerships with the world's leading hyperscalers. And that business has been doing very, very well for us. In store data, we built a whole portfolio of storage controllers, CXL-based memory poolers, and near-memory compute. But here's where we really went all in. And that was in data movement. And this is where our high-speed connectivity portfolio, and when you look at Marvell's data center business today, the vast majority of our revenue actually comes from connectivity. From high-speed optical interconnect inside the data center to long-reach optics between data centers to high-speed switching infrastructure. So today we are the undisputed connectivity leader. And when you step back and look at what we built and where the market ultimately went, I think the results speak for themselves. So back in 2016, Marvell was a $2.3 billion company. As we embarked on the transformation, actually in the first 5 years, we doubled the company, $4.5 billion in revenue. Over the next 5 years, our growth accelerated. And according to consensus estimates on Wall Street for the current year we're in, we're set to grow about 2.5 times over the last 5 years to $11.4 billion. But in the recent couple of years, if you actually drill down, Marvell has been growing like 40% a year. So the growth rate is actually accelerating in the last few years. So at this point, Marvell is off to the races, okay? And based on the outlook that we shared in our earnings call last week, consensus estimates have come up and they expect us now to deliver $16.4 billion in revenue next year. So as I said earlier, when we started this journey, data center represented less than 10% of our revenue, and we bet the farm on it. Last quarter, it was over 75% of our revenue and growing very rapidly. So this is a very different company than we used to be, and the thesis is largely played out. But we're still in the early innings of this infrastructure build-out.